Hello everyone, welcome to Demand Supply Trading Practical Session number 17 for the year 2025. Myself, Surjit Kakkar, and today is Sunday, 27th of April, 2025. And before we move ahead with the session, let's get down to the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with stuff related to demand supply trading. And we also keep updating the schedule for these sessions when these sessions are happening. So in case you're still not part of the Telegram channel and you wish to join it, there are a few different ways how you can do it. The first one is you can simply scan the QR code, which is available on your screen. The next way is you can go to the description. In the description, you'll be able to find the direct link. You can click on that link and you can join the Telegram channel. And plus, when you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. And once you're on our website, you can just scroll down on any of the web pages. And at the bottom, you'll be able to find the Join Telegram button. You simply need to click on Join Now. And that is how, again, you can be a part of this Telegram channel. All right, so just give me a second. Perfect. So today's session is practical application of demand supply methodology. Our demand supply course, which used to be a paid course, is now available as a 100% free course. Now, how you can access the course, we'll definitely talk about it. But when you go through the course, you basically learn the methodology theoretically, right? What is demand supply, how it has to be applied. But unless and until we see some practical application or practical examples, we don't get a very good understanding how it has to be implemented. And that is what we do in these practical sessions. So every weekend, I do a practical session where we'll take an example. To that example, we'll apply the complete methodology. And the best part is that we are not looking into something which has already happened, because that's a piece of cake. You can pick up any chart, apply any indicator, oscillator, and find a number of reasons why you could have been a buyer or a seller. The real beauty is when you're doing the analysis in advance, and that is why demand supply methodology is also called as set and forget methodology, because you can do your analysis in advance. Excuse me. So that is what we'll be doing. We'll be doing the analysis in advance. And just because I'm doing the analysis in advance doesn't mean that I do the analysis and then we forget about it. Whatever examples we look into, whenever they get triggered in the future, we also review them. So basically, you'll be looking at both the before as well as the after. Yes, there might be some time duration, between when we did the analysis and when the example gets triggered. But yes, whenever these examples, they get triggered, I definitely review them. So for today's session, we don't have anything which is pending for review. Whatever was triggered has already been reviewed until last session. So no new trades to be reviewed for today's session. So we can straight away start with our analysis for today. But before we do that, I would also add there are a few requisites, and if you complete these prerequisites, the sessions will be much more easier for you. Now, what are these prerequisites? The very first one is our Trading Essentials course. Now, if you already have a very good trading background, I'll say this can be optional for you. However, I would suggest everyone to go through the Trading Essentials course, specifically someone who is starting as a fresher should definitely go through the Trading Essentials course first. Now, how can you access the Trading Essentials course? Very simple. Once you're on our website, under services, you will be able to find courses. Click on it. And here you can see the very first one is Trading Essentials. Click on it and you have the course available in 2 languages, English as well as in Hindi. So whatever language you're comfortable with, in that language, you can take the course. There is no sign up, no registration required. Once you click on it, it will straight away take you to the playlist where all the lessons are lined up for you. Lesson 1, Lesson 2, Lesson 3. So just go through all the lessons, and that basically covers your Trading Essentials course. Now, once you're done with Trading Essentials, the next one is your Demand Supply Trading course. And again, once you're on a website and the services, you click on courses. The second option is Demand Supply. And once you click on it, again, it is available in 2 languages, English as well as in Hindi. So when you click on whatever language is your preference, it will take you to the playlist where the complete courses available to you. Again, it's a playlist where you have lesson 1, lesson 2, lesson 3. So about 15 lessons. So once you go through all the lessons, you'll be learning the methodology theoretically. Now, once you have gone through the methodology theoretically, like I was talking about, we also need to see some practical examples. So by clicking on practical sessions, you can also access the recordings of the previous session. So currently the archive is almost close to 1.5 years of recording, and they are also available in both the languages, English as well as in Hindi. So you can go through the previous recorded sessions. You can also join these live sessions, which I do almost every other weekend. Now, during these sessions, you will see that I use two documents to do the analysis to make the process very mechanical for us. And those two documents are the rulebook and the flowchart. Now, how can you access the rulebook and the flowchart? Very simple. Again, on our website, once you go to the service tab, you'll be able to find downloads. And here you can see that you have the rulebook. You can simply click on download, and you also have the flowchart. And these are the two documents, your rulebook and the flowchart. And this is what we'll be using during these sessions to understand how to plan trades very mechanically and rule based. So like already said, for today's session, we don't have anything which is pending for review. So we can start straight away with our analysis for today. So what is our step number one whenever we start planning our trade? Step one is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why am I starting with the trade purpose as my very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach. And that logical approach is that the longer I want the duration of the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income is a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, like in these sessions, I'll be taking examples from the NS India market. Now, these markets are not 24-hour markets. And if you are trading such markets, you would have experienced whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, by keeping a position overnight in a market which is not a 24-hour market, I am taking that overnight gap risk, which cannot be avoided. So that is why my recommendation to all of you is that initially our hourly dailies should be done as strictly intraday trades. We don't want to take that unnecessary overnight gap risk. Now, when it comes to weekly monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that we cannot have a gap against us for weekly monthlies. Even in weekly monthlies, we can have gap against us, but the probability definitely goes down since we are leaning against some bigger time frames. But as you start having more and more experience, you start building up confidence. If you want to include daily incomes into overnight trades, it can be done. But it's just that initially, as a risk management rule, we would like to avoid that. So my step one is I need to define my trade purpose, and let's assume I opted, I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, type 2, type 3, or in case I need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily, 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate used for trend analysis. Lower time frame is daily. That is where we get our ACTS from. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Now, mind it, this table, which is on page number 31, is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptos, or maybe if you're trading some international markets, then you can look into the table which is on page number 32. But since I'll be taking examples from the NSE, I'll be using this table for my time frames. So step 1 was I need to define my trade purpose. As soon as I did that, I now have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is now taken care. Now, the next challenge is, yes, I do know my time frames, but again, if you go back to NSE example, I have over 2000 plus symbols listed on NSE. So humanly not possible that I sit and analyze 2000 plus symbols almost every other day. So what we need to do now is we need to have a process in place which can help me shortlist a few symbols out of this very big list. And the way we do that is by using certain computer programs, which are called as scanners or screeners. So if you do a Google search, you'll be able to find a number of scanners and number of screeners available for free. And they are mostly based on conventional technical analysis or fundamental analysis. But if you're looking for scanner screeners, which are purely based on demand supply, then we have some custom built tools, which we call as the demand supply zone alerts and the demand supply zone screener. You can click on these. You can visit our product pages, and that is where the walkthrough videos are available. You can go through the walkthrough videos to understand them better. I'll just quickly show you where they are available on our website. So once you go to our website, you will find under services, you have the option trading view indicators, and here you have the alerts and the screener. So you can just go through them. You can watch the walkthrough videos that will help you understand what these tools are all about. But again, these are scanner screeners, which are purely based on demand supply zones, and they help you shortlist symbols based on demand supply. But one thing you need to remember, irrespective what scanners or screeners you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell those symbols. The job of the scanner screener is to give you a small list. Once you have that small list, you'll have to analyze them one by one and see which one matches with your trade plan. The one which matches with your trade plan can be an opportunity for you. The one which doesn't match with your trade plan, you simply skip it. Now, this process can also be as simplified as, okay, I want a smaller list, so I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours, how you want to get that list for you, but a lot of different options are available, and these two are purely based on demand supply zones. Now, let's assume we got a list, and in that list, the very first one was ABC. So what are we supposed to do now? We need to go to the lower time frame and identify a zone. Now, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my time frames were monthly, weekly, daily, and 60. And out of this, daily was my lower time frame. So here, lower time frame implies, daily chart for me. And on the daily chart, what I need to do is I need to identify a zone. And by zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. Now, again, the best part here is that we do have an indicator on TradingView which automatically identifies these demand supply zones for us. And it is called as the demand supply zone indicator. And we offer a 100% free 7 days trial of it. So if you've still not taken the trial, what you can do is once you're on a website, under services, go to TradingView indicators. And the very first one you can see is demand supply zone indicator. Click on it. And here you'll find the option for 7 days free trial. Click on it. And all you need to do is just fill this form, wherein you'll have to provide your full name, your email address, and your TradingView username. And once you fill this form, within 24 hours, it will get activated for you. Now, in case you don't have a TradingView account yet, you can click here and sign up for a free TradingView account. And if you already have a TradingView account, then you can click here, visit your profile, and identify your correct TradingView username, because if you provide incorrect TradingView username, it will not get activated for you. And again, like I said, once you fill this up, within 24 hours, the indicator will get activated. And once it is activated, you'll get a notification on TradingView itself that now you have access to the indicator and you can try it for free for 7 days. So since now everyone has the opportunity to try out the indicator for free for 7 days, while we do the analysis, we'll be leaning purely against the indicator, which makes our process mechanical, faster, and easier. So what we need to do now is go to the lower time frame. So let's assume this was the symbol which was shortlisted for me. And you can see as soon as I apply the indicator, I can see the demand and the supply areas. So you can see from the current market price, if I look down, we have this demand area, which is a rally-based rally structure. And since the indicator has identified it for us, we'll also mark this as our demand zone. So my step number 3, which was to identify as a zone, the indicator has automatically done it for me. Is the zone available? The answer is yes. Now, once you have identified a zone, does not mean you can blindly trade it. And that's the biggest mistake demand supply traders, they do initially. They find any demand area, they start buying on that demand area. They find any supply zone, they start selling on that supply zone, which is incorrect. Once a demand zone or a supply zone has been identified, the next step is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify it based on the booster scoring. So let's start with these conditions first. So the very first condition we'll check is that can this zone be a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And in this case, our intermediate is weekly. And you can see here, we do have a zone on the weekly. So let's mark this weekly zone. I'll just use a different color to differentiate between the two. So the one marked in pink is my intermediate time frame zone. The one marked in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, which makes it as a coinciding level. Now, since it is a coinciding level, we'll also check, do we have just one zone or do we have multiple zones? Now, by default, you can see the settings of the indicator is to identify quality zones for us. But when you're looking for areas of level on top of level, it is not mandatory that all zones might be quality zones. So what I'll do is I'll change the indicator settings that I want all demand supply structures, not just quality areas. And now you can see it is identifying few more areas for us. But inside of this, we only have one demand zone. We don't have multiple demand zones, which basically tells us that we only have a coinciding level. We do not have a case of level on top of level. So the very first condition we were looking for, which is level on top of level, is not applicable. The zone is not because of a gap. Therefore, gap rules will also not apply. Talking about pivot nor authenticity, we only apply to drop-based rallies and rally-based drops. Currently, we are looking at a rally-based rally. Therefore, pivot nor authentic will also not be applicable. And talking about unstable equilibrium, that is also not applicable because for unstable equilibrium, the leg out should have gone below the basing, which is not happening in this case, right? So if the leg out was something like this, then we would have called it as unstable equilibrium. So looking at all these conditions, none of these conditions are getting applied. If none of these conditions are getting applied, it cannot disqualify the zone, right? To disqualify the zone, first it needs to be applicable. Then there can be two outcomes, either qualified or disqualified. So is the zone qualified for us? The answer is yes. So now that we know we have a qualified zone, again, does not mean we'll blindly trade it. The next step will be the booster scoring. So let's bring up the boosters and see how this one scores for us. So starting with freshness, the demand zone is definitely fresh, gets a score of 3. Strength, we have an explosive move. That is the reason the indicator is identifying it, gets a score of 2. Time at the zone, we only have one candle, again gets a score of 2. Reward to risk ratio will be taking as an assumption because the reward to risk ratio can change based on the arrival. So at the time of taking the entry, we'll definitely have to double check this, and that is why it says dynamic, because this can change based on the arrival. The next thing is your location. If I go to the monthly time frame, you can see that we just hit a monthly demand zone, and that is where we started moving up from. And my zone is also located inside of this monthly demand area. So we are planning our trade very low of the curve, which is the best location to plan a long trade. Sorry, a score of 2. If you talk about the trend, the factors at best locations, trends, they become irrelevant. So it doesn't matter whether we are in an uptrend, downtrend, or sideways. In all the 3 cases, it is going to be a score of 1. So you can see the indicator is telling us currently we are in a downtrend, but what can happen is if prices they move further up, the supply will get violated. and then the downtrend will change to a sideways trend. But since we are at the best location, like I already said, at best location, trends, they become irrelevant. Doesn't matter whether it is up, down, or sideways. It will be a score of 1 in all the 3 cases. Now, talking about move from the zone, we need at least a 4:1 move. Let's see, do we have a 4:1 move? We already have 1:1, 2:1, 3:1. Not a 4:1 move, but yes, prices might move up and then start coming back. So currently, I'll give it a score of 0, but this might change if the prices they go up first and then start coming back. It is not a case of level on top of level. We have already verified that, but definitely a coinciding level. Now, the fact is, whether it works like a trap or it doesn't work like a trap, nothing will change because it has already been upgraded to a type 1 trade, being a high probability setup. But let's see, do we have anything which can make it work like a trap? So if I zoom out, and now what I'll do is I'll try to find an area where the prices have been bouncing over and over again. So if you look at this area, can you see this area in the past? If I just push it a little bit up, can you see it has worked like resistance? Here it has worked like support. And if I go back in history here also, you can see, yes, it has worked like resistance, somewhat support. So we do have a area which is right above our zone, and it has been acting like an area of, here also you can see it on Friday itself. Again, it worked like an area of support. So it has been working like an area of support resistance. So now what will happen is people who believe in support, they would have already bought here or will be buying when the prices again reaches to this area, and their stop loss will be placed below this area, and those stop loss orders will be sell orders. And similarly, if we get a breakout of this area, people who believe in breakout will also start selling. So by the time we enter into this area of demand, we know we'll be having a lot of sell orders coming into the market because of the stop losses, because of the breakout traders. And these people are making two novice mistakes. Mistake number one, they are selling after a decline in price, which means they are selling at a cheaper price. And mistake number two, and they are not selling just anywhere on the chart. They're also selling in an area where the chart has proven to us that back in history, demand exceeded supply, which could be the only reason for prices to move up. So yes, the possibility is definitely there that this might work like a trap. Therefore, we'll give it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 with the assumption of reward to risk ratio, which makes it as a high quality zone, and a score of 5 out of 8, which makes it as a high probability zone. So a high quality, high probability zone can be traded as a type 1 trade. So after applying the boosters, we got to know this is going to be a type 1 trade for us. Now, next thing, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So what we also need to do is we need to be ready for the worst case scenario, for which we'll do a proper position size calculation, so that in case the trade does not go in my favor, it goes against me, I should not lose more than what my trade plan allows me to lose, or my risk management rule allows me to lose. Now, whenever the prices are back, we'll have to re-verify. Reason is markets are not static, markets are dynamic, conditions are changing almost every other second. So before entering the trade, we always have to re-verify, does it still qualify based on my trade plan? If the answer is yes, we place our order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade. And after that, if you get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule-based. And that takes care of our today's example. Now, before we move ahead, I would like to add that if these sessions are helping you, then do like the video. If you're not subscribed to my channel, make sure you subscribe to my channel so that you get notified whenever these sessions are happening. And yes, if you have some friends or family members who are into trading, or if you're part of some trading group, you can share the link to my website, to my course content, to these live sessions, to the trial of the demand supply zone indicator, so that more and more people can take advantage of it. And at the end of the session, I take whatever questions, queries you have. So if you have any questions, queries related to demand supply methodology, you can start putting it into the chat box. And before I get into those questions, queries, the last thing I would like to add is that there was a feedback which we have been getting from you people, which was that what if I don't want to ask my questions publicly, or what if I want to share my analysis, which cannot be done on the YouTube chat. So we now have an option for one-to-one session. So once you're on our website, or at the top right corner, you'll be able to find one-to-one option. And using this, you can schedule an appointment with me. There are 2 options available: a voice call. So if you feel that, just asking your question over a voice call is good enough for you, you can schedule a voice call appointment. Or if you want to share your analysis, you can also schedule online meeting with me, right? So this option is definitely available. But yes, even otherwise, you do have the option that you can always put your questions, queries in the chat box during these live sessions. And at the end of the session, I definitely try to answer as many as possible. All right, so let's see what do we have in the chat box today. Can you add option indicator HVIV on your website to access it? See, what you need to do is to get access, you simply have to send us an email, and in that email provide us with your TradingView username, and it will get activated within 24 hours. How can I get IV for Nifty futures, since I want to trade Nifty and Bank Nifty options intraday, since IV should I'll focus on strike price. See, again, when you're trying to get the IV, you don't use the IV for the futures contract. You'll still be using it for the index, right? So you simply have to use the index to get your IV values. When marking crypto zones for HIT, can we use tested zones since they are 24? See, again, when it comes to 24-hour markets, just because it is a 24-hour market does not mean that you can use tested zones, right? We understand the difference between a fresh zone and a tested zone, right? If the zone is already tested, some of those pending orders might have already been depleted. Now, this will more boil down to how conservatively or aggressively you want to trade, right? Now, me being a conservative trader, I always prefer to trade fresh zones. I never use tested zones on the lower time frame. The only exception is when you have cases of level on top of level. But if you're an aggressive trader, you want more number of trades, you want to use tested zones, yes, you can do that. But what might happen is most of your trades might convert into a type 2 or a type 3 trade. So again, the duration of the market has nothing to do whether you want to use tested zones or fresh zones. It all boils down to how conservatively or aggressively you want to plan your trades. Right now, due to war situations, I normally focus on HITs or DITs. Should I change my focus? See, again, it also depends again on your personality style. If you go through the rule book, you will see that I have already given some rules for when you have such key events, right? Like you can see, the very first one is do not trade. Maybe I want to give a pause for a week or 2 weeks. I want things to settle down, and then I want to get into the market. So that's being a very conservative trader. Now, this is not an event where you know that this event is going to happen, at this point. So I can do 30 minutes before, 30 minutes after. So this is for something like when you have, let's say, earnings coming out for a company, or let's say your RBI, it is disclosing your interest rate. Right now, in such scenarios, you can say, okay, I only want to trade the best locations, which is either very high of the curve or very low of the curve. You can also say, okay, even if I am trading other locations, I will only trade zones which are 10 out of 10 and still do them as type 2, type 3 trades. So that is again how you can safeguard yourself. And yes, something which you already said, can I avoid HITs and DITs and be more focused on MITs and WITs? Yes, that is also something which can be done. But again, like I said, it all boils down to how conservatively or aggressively you want to participate. Okay, during HIT, can I use tested zones in intermediate time frame? So when it comes to intermediate time frame, we are only using for identifying zone violations. For the zone violation analysis. So anyhow, you're not planning your trades from the zones which are on the intermediate time frame. So that is why, yes, we do look at tested zones, because we also want to look at the violations of the zones which were tested and maybe eventually got violated. For intraday, should I go for HITs? See, again, it's completely your call, because see, the smaller the time frame, the faster the conditions are changing. So if you feel you're comfortable with HITs, yes, you can do that. If you feel that I don't want to be into very quick trades, maybe DITs are more suitable to me, you can do that. So at the end of the day, it's your call. And if I'm doing options, should I do for 1:1? See, 1:1, you should not be doing any kind of trading, right? Because the first thing you have to understand is there is no such strategy where you will be making money on each and every trade. We do understand that we will have stopped out trades. So when we know that we'll have stopped out trades, the only way to be profitable is by ensuring that my rewards are big and my risk is small. And 1:1 does not give you that edge. Okay, sometimes in gap up, gap down, it touches the resistance line and gives a type 2 or a type 3 entry. See, again, if the zone is already violated, it is no longer valid for us. So ideally, if I see the distal line has been breached or touched, and after that you're getting an opportunity for a type 2 or a type 3 entry, I'll never do that. I will only do for zones which are still holding and not violated zones. Okay, so I've already answered that query. So that basically brings us to the end of today's session. Thank you everyone for joining in. I will be seeing you next during the next weekend. Till then, fit safe. Enjoy your Sunday. Take care. Bye-bye.